Assalamualaikum, good morning everyone. My name is Umar Adi bin Ibrahim, and on behalf of our group, welcome our presentation on the financial ratio analysis of Tenaga Nasional Berhad, also known as TNB for the financial year 2024 and 2025. This assignment is submitted for BBAF1013 and BBCF2013 financial management for the January 2026 semester under the Faculty of Business and Management. Our group consists of 6 members: Umar Adi bin Ibrahim, Nur Amalina binti Ahmad Shoaib, Nur Aliana Izzati binti Zuraini, Muhammad Ashar bin Khairul Anwar, Nur Mas binti Khalid, and Muhammad Akram bin Ismail. Throughout this presentation, we will walk through TNB company background, key financial ratio, profitability, trends, liquidity, leverage, agency, and our overall conclusion. Let us get started.
Hello, my name is Nur Amalina binti Ahmad Shoaib. Slide 2. TNB Financial Ratio Analysis Overview. Let us begin with a high-level overview of what this analysis covers. Tenaga Nasional Berhad is Malaysia's largest electric utility company, listed on Bursa Malaysia under stock code 5047. In the presentation, we analyze TNB financial performance for the financial year ending 31 December 2024 and 31 December 2025, which we refer to as FY 2024 and FY 2025. As you will see throughout our analysis, FY 2025 was a landmark year of TNB. The company demonstrated exceptional final performance with improvement across all key final metrics. We evaluated to a total of 60 final ratio across 4 categories: profitability, liquidity, leverage, and efficiency. And the finding consistently point us to a stronger, more recent TNB in FY 2025.
To understand TNB journey, let us briefly revisit its history. TNB origin traces back to 1949, when the Central Electricity Board, or CEB, was established under British colonial rule to supply electricity across peninsular Malaysia. Over the following decade, the organisation evolved into the National Electricity Board, or NEB, continuing to expand infrastructure and service coverage. A major turning point came in 1990 when the Malaysia government comprised NEB into Tenaga Nasional Berhad as a part of the country border privatization agenda. Just 2 years later, in 1992, TNB was listed on the Kuala Lumpur Stock Exchange, now Bursa Malaysia, making its transformation from a government agency into a commercial public company. Today, TNB is majority owned by Khazanah Nasional Berhad, Malaysia Sovereign Wealth Fund, alongside the EPF and PNB as major institutional shareholder. Since its listing, TNB has expanded beyond Malaysia borders, with international operation in the United Kingdom, Australia, Kuwait, and Ireland. Domestically, TNB remains at the forefront of Malaysia's energy transition, with a commitment to achieving net zero carbon emission by 2050. In 2050, TNB entered its 4th incentive-based regulation period, known as RP4, covering 2025 to 2027, with approved capital expenditure of up to 42 ringgit at 2 billion for grid modernization and renewable energy expansion.
Hai, Assalamualaikum. My name is Muhammad Syabin Karanwa. Sudah hari 2025 0701 0082. Company overview. Moving on, TNB's current profile as a company. TNB is unquestionably Malaysia's market leader in electric utilities. It serves approximately 10.4 million customers, both residential, commercial, and industrial, and operate a power generation capacity exceeding 13,000 megawatt. Beyond Malaysia, TNB has established a meaningful international presence with energy investment in the United Kingdom, Australia, Kuwait, and Ireland. This diversification reduces the company's dependence on any single market. Look ahead. The NB strategy vision center on supporting Malaysia's net zero carbon emission target by 2015. This includes rapidly expanding in its renewable energy portfolio and embracing new growth opportunities such as serving data centers and participating in cross-border electricity trade. In summary, TNB is not just utility provider. It is a strategic national asset and growing national energy player.
Hi, Assalamualaikum. My name is Nur Sheikh Masmedi Khalid, student ID 202507010075. Slide 5, Core Business Segment. TNB Business is organized across 4 core segments, each playing a critical role in Malaysia's electricity value chain. The first is power generation. TNB operates a diversified fleet of power plants, including coal-fired, gas-fired, hydroelectric, solar and wind facilities, with a combined installed capacity exceeding 13,000 megawatts. The company is also accelerating its renewable energy transition under the National Energy Transition Roadmap. The second segment is the transmission grid. TNB maintains the national grid across Peninsular Malaysia with over 26,000 km of high-voltage transmission line ensuring electricity flow reliably from power plants to the distribution network. Third is the distribution network. TNB serves its 10.4 million customers through this segment, and it is actively modernizing through smart meter deployment, distribution automation, and vulva optimization technologies. Finally, TNB provides retail and energy solutions through its subsidiary G-Spark, which offers rooftop solar installation and energy management service to residential and commercial customers. TNB also participates in the Corporate Renewable Energy Supply Scheme and the Corporate Green Power Program for industrial consumer. Together, these 4 segments make TNB a fully integrated electricity company with control over the entire chain from generation to end consumer.
Hi, my name is Muhammad Akrami Ismail, ID student 202507010076. Before we dive into the detailed electoral analysis, let us highlight TNB headline financial result for FY 2025. Total revenue reached RM 67.7 billion, a significant 19.4% increase from RM 56.7 billion in FY 2024. This growth was driven by highest electricity demand, particularly from data centers, commercial consumers, and cross-border trade with Singapore. Net profit come in at RM 4.77 billion, representing a 19.8% increase from RM 3.98 billion in the prior years. This confirms that TNB revenue growth translated into real bottom line gain from shareholder. In terms of dividends, TNB declared 53 cents per share, the highest dividend payout in 5 years, reflecting management confidence in the company's financial strength. And looking ahead, TNB has been allocated RM 42.8 billion in approved capital expenditure under the RP4 regulatory framework for 2025 to 2027. This major investment will fund modernization, renewable energy projects, and smart infrastructure upgrades. These headline numbers set a strong foundation as we now walk through each ratio category in detail.
Let us now examine TNB profitability ratio, starting with gross profit margin. This improved from 24.3% in FY 2024 to 27.5% in FY 2025. This means TNB retained more revenue after deducting the cost of generating electricity, primarily fuel cost, and purchase power from independent power producer. The improvement reflects better cost recovery through the ICPT mechanism and the favorable RP4 regulatory reset, which provide TNB with higher approved return on its regulated asset base. The operating profit margin expand from 50.0% to 70.0%. This tells us that TNB core operations are becoming increasingly profitable as fixed costs like depreciation and overhead were spread over a large revenue base, sign of healthy operating leverage. Finally, the net profit margin remained effectively stable at 7.2% in FY 2024 and 7.4% in FY 2025. While the margin percentage is nearly unchanged, it is important to note that the absolute net profit grew by RM 789 million, an increase of 90.8%. The slight drag on net margin was due higher finance costs from TNB, expanded borrowing for capital expenditure, and higher debt provision overall. Overall, TNB profitability story in FY 2025 is one of improving quality and scale. The company is generating more revenue and converting it more efficiently into profit at both the gross and operating level.
Slide 8. Return on investment. Beyond Magri will also assess how Infinity TNB is generating return from its asset and shareholder equity. Return on asset or ROA improved at 2.49% in FY 2024 to 2.96% in FY 2025. What made this improvement especially notable is that TNB total asset grew considerably during the same period, from RM 159.8 billion to RM 177.3 billion. Despite this significant asset expansion driven by ongoing capital investment, TNB managed to generate proportionately higher profit from its largest asset base. This confirms that new investments are yielding productive return. Return on equity or ROE increased from 9.10% to 9.17% 2.7%. This means shareholders are seeing better return on their invested capital. Total equity also grew from Rm 43.76 billion to Rm 49.1 billion. So ROE improvement ongoing, equity based on even more positive signal. Both metrics together reinforce this calculation that TMB is deploying capital effective and becoming a more return efficient company year on year.
We now turn to liquidity. TMB ability to meet its short-term financial obligations. The current ratio improved from 0.78x in FY 2024 to 0.83x in FY 2025. At first glance, a ratio below 1.0x might appear concerning. However, for regulated utility company like TMB, this is entirely normal and expected. Utilities have highly predictable and stable cash flows from regulated operation, strong credit rating that allow easy access to short-term financing, and a structural mismatch between long-term asset and short-term liabilities. TMB hold A3A credit rating from RAM rating, which confirm that financial market view it as a highly creditworthy borrower. The direction of improvement moving closer to 1.0x is the important signal here. The acid test ratio, which excluded inventories from current asset, improved from 0.63x to 0.69x. For TNB, inventories consist mainly of full stockpiles and spare parts and that cannot be quickly liquidated. The improvement in this ratio reflects stronger liquid asset coverage, supported it in part by faster receivable collection. That brings us to credit quality. TMB 3A rating from RAM rating providers reassurance that the company below negative 1.0 liquidity ratio do not represent financial distress, but rather a capital structure typical of large infrastructure companies.
Leverage and debt management. Next, let us look at the NB's leverage position and its capacity to service in debt. As a capital-intensive utility company, investing billion annually in infrastructure, the NB naturally carries significant level of debt. Our analysts reveal three key insights here. First, the debt ratio declined marginally from 0.73x to 0.72. This means approximately 72 cents of every ringgit of the NB's assets are financed by liabilities. The slight improvement indicates that equity is growing slightly faster than liabilities, reflecting a gradual strengthening of TNB's capital structure. Second, the debt to equity ratio also improved from 2.065x to 2.61. Again, while the ratio remains elevated compared to non-utility sectors, the downward trend is positive and consistent with disciplined capital management. Third, and most importantly, the interest coverage ratio improved significantly from 2.15x in 2024 to 2.79 in 2025. This ratio measures how many times TNB's operating earning can cover its interest expense. The sharp improvement demonstrates the earning growth is comfortably outpacing the rise in financing costs, with RP4 providing regulatory certain through 2027. TNB's interest coverage is expected to continue improving as new assets begin generating regulated returns. In summary, while TNB's leverage is high, the trajectory is improving and the debt management is prudent and sustainable.
Slide 11, Operational Efficiency Gains. Let us now review TNB's operational efficiency ratio, which assesses how effectively the company is utilizing its resources. Starting with the average collection period, this improved from 25 days in FY 2024 and to 22 days in FY 2025. This means TNB is collection payment from its customer 3 days faster on average, which directly improve cash flow. This reflects stronger customer payment discipline and more effective debt collection processes. Inventory turnover increased from 6.0x to 6.6x, meaning TNB is cycling through its fuel stockpile and material more efficiently. More inventory turns per year signals better supply chain management and reduced holding costs. Total asset turnover improved from 0.35x to 0.38x. This means TNB generated more revenue per ringgit of total asset in FY 2025, a sign that the asset base is being utilized more productively. Finally, fixed asset turnover increased from 0.4x to 0.55x, indicating that TNB's power plant, grid infrastructure, and other fixed assets are generating higher revenue per unit of investment. All four efficiency metrics improve simultaneously, which strongly suggests that TNB's management is executing well on operational discipline and asset utilization programs.
Key takeaways. Before we close with our formal conclusion, let us summarize the three most important takeaways from this analysis. First, FY 2025 was an exceptional year for TNB by any measure. Revenue grew by 19.4% to RM 67.72 billion. Net profit increased by 19.8% for RM 4.77 billion. And dividends reached a 5-year high of 53 cents per share. Second, the performance improvement was broad-based. All 16 financial ratios we analysis either improved or remained stable. This is not a one-dimensional result. It reflects genuine improvement across profitability, liquidity, leverage, and efficiency simultaneously. Growth was driven by favorable ICPT cost recovery, RP4 regulatory returns, rising data center electricity demand, and operation efficiency programs. Third, TNB growth trajectory is sustainable and structurally supported. Key structural tailwinds include a 5.9 gigawatt data center pipeline secured as at end 2024, ongoing renewable energy expansion, and the RM 42.82 billion RP4 capital investment program. This position TNB strongly for continued performance improvement in FY 2026. Conclusions. In conclusion, our financial ratio analysis clearly demonstrate that Tenaga Nasional Berhad achieve a significant and well-rounded improvement in its financial performance in FY 2025 compared to FY 2024. TNB's stronger profitability supported by robust revenue growth and effective cost control highlight its ability to capitalize on increasing activity demand from emerging sectors such as data centers and cross-border energy trade. Where liquidity remains slightly below the conventional 1.0 benchmark, the gradual improvement and TNB stable, predictable cash flow profile indicate that the company is in a sound financial position. Regulated utilities commonly operate below 1.0 current ratio, and TNB BBAF credit rating affirm this is not a distress signal. On leverage, prudent debt management and proven interest coverage reflect a balanced approach to financing large-scale capital investment while maintaining financial stability. The sharp rise in interest coverage from 2.15 to 2.79 is particularly encouraging. And in terms of operation efficiency, all four efficiency ratio improved simultaneously, confirming that TNB is attracting more value from its asset base years on years. Overall, FY 2025 can be regarded as a strong and resilient year for TNB. The company is well positioned for sustainable growth and continued support of Malaysia's long-term energy transition goal.
For the discussion and outcome, let us now discuss what this number collective mean for TNB overall financial health. On profitability, the improvement in gross and operating margin confirm that TNB core operations are becoming more profitable and scalable. ROA and ROE also improve, indicating better allocation of both assets and equity. The near stable net profit margin is explained by higher finance costs from expanded borrowing, but the absolute profit growth of RM789 million remains a strong result. On liquidity, while the current ratio sits below 1.0, this is structurally expected for related utilities. The improvement is the quick ratio from 0.63 to 0.69 combined with faster risk-bill collection show that the TNB liquid asset position is strategic. This is a positive development, especially given the scale ongoing capital expenditure. On leverage and efficiency, both are improvement together, which is a help combination. Leverage ratio decline, margin will the interest coverage ratio rose sharply. Simultaneously, our four effective ratio improve, confirming that TNB is generating more revenue from its asset and equity base without property it carries in cost structure. Take together, this finance paint of picture a fundamentally stronger company in FY 2025, one is growing profitability, manage a deep responsibility and operating more efficiently.
Finally, to directly answer the core question of our assignment, is TNB doing better in FY 2025 compared to FY 2024? The answer is a clear, well supported yes across multiple dimensions. From a financial performance standpoint, revenue increased by 19.4% to 67.72 billion. Net profit rose 19.8% to 4.77 ringgit Malaysia billion, and dividend reached a 5-year high of 53 cents per share. These are strong construct results. From an operational and structural standpoint, broad-based gains come from higher electricity demand, especially from commercial and data center customers. Better full cost management through the ICPT mechanism, faster receivable collection, foreign exchange gains and lower taxation. Regulatory support under RP4 also provided a meaningful boost to allow return. And from the perspective of inverter metric, ROE improved from 10% to 9.71%. Coverage rose from 1.15x to 2.79x. And multiple asset utilization ratio show efficiency gains. This indicator confirm TMB is generation better returns from both its asset and equity in FY 2025. We are confident in concluding that FY 2025 represents one of TMB's strongest financial performance in recent history, and that the company is well positioned for continuous growth in support of Malaysia's national energy agenda. Thank you for the attention. We are happy to take a question.